We are now moments after the market ended the last day of 2022, which was one of the worst years in the last decade. We're going to summarize, instead of the week, we're going to summarize 2022 in the best way possible, zooming in, zooming out to better understand what moved the markets in 2022. Are you ready for it? Let's go! Welcome back to the channel. If you're new, welcome. If you're an existing viewer, thank you very much for coming back, for returning for another episode of Let's Talk Stocks with Micha Stocks. I'm Micha. This is our channel, which has grown almost to 1,000 subscribers. So if you know someone that likes these weekly recaps, yearly recaps, and we're going to start uploading more and more content to this channel, they can, and you can also subscribe to the channel. And if you subscribe and move the bell into all, you'll be able to get notifications every time a new video is posted. As I mentioned, we are minutes after the market ended. Let's look at the markets. This is how 2022 will be remembered. The Dow Jones ending at a minus 9.4. The S&P averting a bear market year, 19.95, which 20% represents a bear market. NASDAQ deep into bear market territory, minus 33.89, almost 34. And the Russell 2000, the IWM, minus 22.2. One of the worst years. We're going to see where it ranks versus other years. When we look at the different indices, we can see energy outperforming everyone by a mile at least, 64% up on a year where everything was down. Also utilities with a 1.4% gain. But when you look down the table, you can see communication services minus 37%, consumer discretionary 36%, and of course their tickers are on the left. Then technology and real estate, very, very bad year for the most common stocks in the markets, the ones that impact the most the major averages. When we look at a scatter plot of the S&P 500, we can see that the worst performer in the S&P 500 is Generac, GNRC, the producer of generators and battery storages. After that, Match Group, Allegion, Meta, Tesla, PayPal, and others. They're the worst performers, but the best performers on the other side of the scatter plot are the energy sector companies. We can see Oxy Petroleum up here, Occidental Petrol. You need to go really far to see it. Over 117%. Warren Buffett took a large stake in the company during the year. Didn't really help it go up beyond what it did, but still a very huge increase in 2022. Hess Corporation, Marathon Petroleum, ExxonMobil, Schlumberger, APA, Halliburton, all of them above 70% in a year, where we'll talk about gas prices in a few minutes, and oil prices didn't do that amount of gain. Will they give it back in 2023? That's the big question. So yes, we saw value outperform growth in a very, very dramatic way. When we look at it at the companies in a different way, you can see when you're positive, you might be in the energy sector or around Walmart and Goldman Sachs. When you're negative, you might be Starbucks, Nike, Disney, Tesla, Amazon, PayPal, and Meta. Thanks to Charter for plotting that in a very interesting to see way. When you look at the crypto market, well, the damage there happened earlier in the year, and actually they had two major damages. We're going to talk about that. Bitcoin down 65% over the year, and Ethereum, ETH, down 68% during 2022. And if we look how we rank across the different years, we can see that because we averted the 20%, which was on the verge, we came back, let's say, fourth from the bottom, around here. One of the worst years in the last decades. Precedes a very strong 2 years, but 2022 will be remembered as a very, very bad year. And after we have all that, let's go back. Sit back and look at the year piece by piece. This is the S&P 500. This is the way it's plotted over time. And we can start the year by inflation. Inflation was one of the biggest drivers in the market this year. Inflation started heating up from the beginning of the year and started the heat itself started around 13th of January. Then end of February, 24th of February, Russia strikes Ukraine, which lifts oil prices in a very rapid pace. We're going to talk about them in a second. This creates pressure, inflationary pressure on the market, which moves the Fed to start lifting rates and signal that they're going to lift at least 6 more times. That happened around the Fed. And anyone that tried to fight the Fed around March found themselves with an S&P instead of 4,400, 3,800. That created the ripple effect of markets going down. U.S. economy started shrinking. Inflation started increasing in a rapid way. And by May 5th, the Fed starts hiking rates in 75 basis points, which brings the rate, in 5th of May, the Fed rates were higher than all the years since 2000. Later on, in June 16, they increased the rate by 75 basis points. You can see also around May 11th, gasoline prices hit a record high. We remember that. We topped $5 per gallon. And of course, the S&P hits bear territory on May 20th. After that, there was a bit of, let's call it optimism in the market. But then June 3rd, Microsoft cuts its forecast. One of the biggest companies in the world, actually the second biggest company in the world, cuts its forecast. I think it's one of the biggest companies that cut their forecast in 2022. We'll see in 2023, blaming the strength of the dollar. The Dixie went up very high. That was the point where the dollar was very strong because the Fed was the first to react, the first to increase rate, automatically increased the dollar price, which later on cooled off because all other federal banks started also increasing rates. Fed on 16th of June starts hiking by 75 basis points, keeps lifting rates over and over again, and we got to a point where we're at 4.25 to 4.5% of rate hikes by the end of the year. Also, around, where's that? July 6th, oil goes down under $100, which contradicts what we saw in the energy sector. That would be very interesting to see what will happen in 2023. And the next leg down for the market started when Beijing on August 16th decided to cut their rates as they saw their growth, China growth slows down because of the zero COVID, because of all the things that happened in China during 2022. And actually another bottom was created October 12th, which was not even related to the US economy. It was related to the UK economy after the pension funds there almost bellied up and lost most of their assets due to wrong trading positioning. The Bank of England needed to print more money. And after 45 stormy days, Liz Truss, UK Prime Minister, leaves the house at Downing 10 at October 21st. And the last thing that was very dramatic this year was around the crypto. Sam Bankman-Fried arrested 13th of December in the Bahamas and a week ago extradited to the US. And right now he's waiting for his trial basically to get his sentence. And that is the year in review of 2022. Let's dive in to specific areas in the market which really impacted the prices of stocks, impacted the prices of bonds during the year. We're starting with market cycles. If you're in the camp that this bear market ended, then this might be one of the shortest bear market. Not a long bear market. It might be one of the shortest bear markets that we have, 282 days, where the average is 339. So if it was a bear market, actually it was because we were 20% less, but from the moment the bear market started, 282 days, which made it one of the shortest. So it really depends on which side of the argument you might be. When you look at market cycles, you can see that the decline wasn't the steepest, as 2020 was fastest, then 87, then 61, then 66. We're right after that. So it was a rapid decline, but not the fastest. And all this is post-World War II, of course. When we look at the year after, you can see that the year after starts looking a lot better, whether it's 3 months, 6 months, 9 months, and 12 months. Now, I haven't come for the future, so I have no idea if that's what's going to happen. But at least it gives us a bit of optimism to look forward. And I'm going to talk about 2023 at the end of this summary. Let's keep on going. Federal Reserve found themselves on the wrong side of the market. Actually, when you look back at December 2022, they assumed that in December 2021, that in 2022, the maximum Fed rate would be at 1.25. Only two Fed members thought that would be the nominal rate. We are now at December 2022, 12 months later, and you can see that right now, not that they're too pessimistic, but actually right now they believe we're going to keep on hiking to around 5%. They were very, very late to the game. And part of the speedy increase of rates was because they were very late to the game. Let's talk about the speedy increase. We can see it from Charter that mapped it. You can see that the pace of hiking rates, and this stops at November. So there's another rate that brings us here, is the steepest in the last, how many do we have here? 1, 2, 3, 4, 5. In the last 5 rate hikes of Fed rate hikes, which means that the economy needs to withhold a lot of stress. And currently, the economy is standing very strong. So is the Fed hiking too fast or too slow? Evidence shows that they're hiking very, very fast. When we look at the PEs, which are the way to evaluate companies, we can see that we are not yet, after all the decline, we are not close to the long-term average. The long-term average for the price to earnings is around 15.8, sorry. We are now at 19.62. Does that mean we have another leg down of about $4, which is 20% down on the S&P? It really depends if you're in the camp that we have another leg down. If you want to go back to the long-term averages, if you believe that the long-term averages are the ones that we need to meet, then there's another 20% in the cards. If you say, you know what, the economy changed, the economy is strong, it doesn't need to go that low, then maybe we've seen the bottom. No one knows. The only time you know when you have seen the bottom is after you're far away from the bottom. The other thing that happened this year and was major discussion across all the financials and all the financial institutes and website was, of course, the yield curve. The yield curve inverted during 2022 and created a unique situation where short-term treasuries became more attractive than long-term treasuries, which usually is not the case. When that happens, usually financial institutes make less money because they cannot leverage an arbitrage long-term for short-term. And historically, every time that happened, when you look back, that meant that a recession is coming or we are in a recession. Now, there are two ways to look at this. One is that we already are in a recession, but no one has declared it yet, or we are going into a recession. But the way the Fed looks at the yield curve, they look at the 3 months versus the 10 years. We are inverted. You can see the gray line here, which means that you can get a better rate of return for 3 months versus a 10-year, which means that the yield curve is inverted. And every time that happened over the history, a recession followed, which means that according to this, 2023 is probably going to be a year that we will see a recession. Will it be a mild one? Will it be a hard one? Will the Fed do something before that? Or will there be a recession that will be declared actually on 2022? No one really knows. The other thing that was front and center during 2022 was the inflation. Inflation came in hot, almost 9% inflation, but cooling down in the last few months. The question is it cooling down fast enough? We've seen the real estate market crushed during the last few months. We see food prices going down, oil prices, gasoline, travel, everything coming down. Is it coming down fast enough? And that is not the right question to ask. You know why? Because at the end of the day, it's being measured in a very specific way. When you take the way it's being measured, and you can see here on the table, and all this information, by the way, is from the bespokepremium.com. You can join them. There's no affiliate link or something like that. You can just go to their website and subscribe. I think they have 14 free, the first 14 days free. You can join them. And I want to thank them, of course, for gathering all that information. This is the actual year-over-year CPI, which is the price index, the consumer price index, the inflation. You can see that we peaked around June at 9%, and we're now at 7.12. Up to now, everything is clear. Now, Fed funds rate, this stops in November, so there's another print in December. December was 7, and Fed funds rate is 4.25. Up to now, we're good. Now, why am I saying it's only the math, it's not even the inflation? If we keep on going up, let's say inflation keeps going up by 0.1% on a month-over-month basis. This brings us to this column. If we're here at 0.1, it means that around March 2023, we will be at 4.1% CPI. If we're at, if we keep on going with 0.1, we're at 3.87, 2.97, and we're under 2%. Why? Because last year, you can see the rapid decline in CPI. When we go down and the delta between one month to the other, between year over year, is smaller, it means we're going down. So from a math perspective, if inflation cools down, we don't actually need a negative print. All we need is very shallow inflation month over month, which will bring us very fast to under 5%. What that means is that the Fed funds rate is going to be higher than the inflation, which means that the Fed is probably going to stop hiking rates. Now, whether it's going to be on the February, is going to be the last rate hike, or March or April, no one really knows because we're still waiting for the inflation prints. But from sitting back and looking at the data, it's clear that we're at we're getting very close to a turning point. Now, that doesn't mean that the market won't go down the first quarter or the second quarter of 2023. It does not mean that. And of course, everything you see here is not financial advice. It's just education and entertainment purposes for sure. But it means that from a math perspective, we're on the path of a rapidly slowing or going down CPI. And if that's the case, then the Fed doesn't need to bring the economy to a recession. Will they do it? Won't they do it? That's a question that we'll talk about during the channel. Now, let's talk about employment, because employment is going to be front and center in 2023. The reason for that is because that is currently the only thing that is holding the Fed from stopping to hike rates. The reason for that is employment keeps being very sticky and very strong. Wages are sticky. People are still getting salary increases, and the employment or the unemployment is very low. When unemployment is very low, it means that people can still get jobs, can still get very high salaries. And if they get very high salaries, it means that inflation won't cool off because they're willing to pay any price for things that they want. The Fed wants to see employment or initial jobless claims go up, but they're not going up. Will they go up? We did see a lot of layoffs in November. December actually cooled down almost by half. The reason is because of Christmas and end of year. Beginning of, or actually during January, I assume we're going to see a very high number of layoffs, but we will need to see that, at least according to everything that happens in the market. So this is something you should follow, the unemployment rate or the initial jobless claims. And we can't not talk about Washington. And this is not a political channel. I'm not going to go into Republicans, Democrats, or anything else. But what I can show you is that during the 4-year of a presidential cycle, since 1928 all the way to 2022, the blue line shows the average gain of the S&P 500. You can see that year number 2, which we just ended, is considered the worst year on average. When you look at the average S&P 500 over the course of 4 years, year number 2, which we just ended, it was supposed to be a very, let's say, the worst year of a 4-year cycle, 3.5%, and it happened 54% of the time. When you look at year number 3, that's where the optimism is. The optimism is in. Too many words together. 13.5%, 82% of the time, which means that if you believe in cycles, this might be the cycle in 2023. Now, will it happen? Won't it happen? Does it happen when a Fed increases rates? Will the Fed increase rates? Does it happen when we're in this kind of climate? Everything is up for grabs. But at the end of the day, it's statistics. And if you follow math, this should be the case. Let's continue. Investor sentiment was one of the worst in the last, I want to say, even decade. Look at the amount of bearish sentiment in 2022. We had an average weekly sentiment reading highest than the way it was measured since 1987. People are bearish, and they're not even bullish, because when you look at the other side, we're at the lowest bullish reading since 1987. So everyone is right now on one side of the boat. Everyone is saying things are bad. When everyone is saying the same thing, usually the market has a tendency to surprise everyone. Will they surprise in 2023? That's the big question. And we will end at least this recap. No, we have a few more things. We won't end it at crypto. Crypto had a very, 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 very bad year, down 65%. You can see that the market cap went down from 3 trillion to 823 million. A huge loss in capital. But on the bright side of that, you can see that the volatility went down in the last 6 months. The reason for that is because no one cares about crypto anymore. So people that already have their crypto wallets or their Bitcoins don't really want to move anything because they're convinced of the crypto cycle. New money doesn't flow in because people don't want to go into it. That creates almost zero volatility. And that's why we see that on a day-to-day basis, Bitcoin doesn't really change its price, which means, without saying it out loud, that it might have bottomed. We'll see in the next few weeks. Thanks to New Age Wealth, Cameron Dawson produced around 20 different slides, 20 different pieces of information. I took only a few. You can, of course, follow New Age Wealth on their website. You can download the whole presentation, but I'm just using, I think, two. Yeah, two. The first is the oil. This is the big paradigm in 2022. The reason for that is, look, black line, oil prices. Blue line, gas in the gas station. You can see that where we started January, we ended December. Meaning the whole Russia-Ukraine went down all the way, and we're back to where we started. But going back to the U.S. sectors, you can see that XLE is up 64%, which means that something will happen. Whether it would be oil prices spiking up, or the energy companies, which are underweighted in the S&P. And that's the reason why money flew inside. And they provide dividends and they provide safety. I can provide you all the reasons why they went up, but this disparity never happened. And usually it's closed itself when you look at history. And the downside usually happens in the assets and not in the commodity, which means that the XLE and the energy companies might have a very difficult 2023. Again, that is the history. It doesn't mean that that's what's going to happen. Most of the analysts actually recommend the energy to be overweight. So you can choose whatever path you take. 2022 was a very bad year for growth stocks versus value stocks. You can see that when you divide them one by the other, you can see that growth stocks are going down in their value versus the value stocks, which means that a lot of investors went to value stocks in 2022 because of all the rapid climate change versus growth stocks. And the leader of growth stocks, ARK Invest, year to date, the poster child for growth stocks, went down 68%. And when you look at the 5-year return on the ARK, you can see that since 2018, when it was $39, basically right now it's trading lower than it traded 5 years ago, minus 20%. A very, very bad year for growth, of an even worse year for Cathie Wood and her fund. And by that, we have ended the summary of 2022. But we can't stop here. We need to look at 2023. Now, I'm not going to spend too much time on 2023 because we can only predict, try to predict, or even prepare ourselves. So let's look at 2 or 3 different pieces of information that might help us look at 2023 through the eyes of the experts. And the way to do that is we look at, where's my, here you go. Let's see that you can see. Yeah, you can see the screen here. Here it is. These are the price targets by the different financial firms. You can see that we ended at 38. The S&P ended, where's the S&P? 38.39. 38.39 brings us down here, which means that we have only 3 analysts that believe that 2023 would be a negative year versus 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 analysts believe that it's going to be a green year. So if you don't do anything, in theory, if they're right, the S&P 500 would end the year higher. But, there's a capital letter but here. Last year they thought that 2022 is going to be a positive year, and look where we ended. So, there's a lot of questioning around the analysts and the way they predict. You can also see, when you look at the earnings per share estimate for 2023, you can see the wide range between the different analysts. The difference, why they get to the different prices, because they put a different PE ratio on their earnings per share. Some believe that earnings per share would go down, but they put a higher PE. Some think that it will stay the same, but they put a lower PE. At the end of the day, this widespread is not common. Usually, everyone says the same thing. And actually, when you dive in, when you double click these projections, you can see that most of them believe that the first quarter and the second quarter are going to be very, very bad, at least according to them. And after that, when we land, whether it's a soft landing or a hard landing, we're going to start seeing the turnaround in the S&P 500. Maybe we've seen the bottom. Maybe we're going to touch the bottom again. Maybe we're going to create a new bottom. No one really knows. What we do know is that everyone is very frightened going into 2023. And also, when you look at the cycles themselves, again, if you believe in the cycles, and here we can thank Ryan Dietrich from Carson Group, 2 negative years, one after the other, are usually not that common. Although it might seem like 2023 is going to be negative, you can see that it's every few years we do get a negative year. By the way, 30% of the years are negative, which means that 70% of the years are positive, of course. But a consecutive 2 negative years is usually not that common. It happened twice since 1950. It happens around the 1970s, 1974, and it happened around the dot-com bubble. If you believe we had the dot-com bubble and that's why we went down, then second year is in the cards for you. If you don't believe that, then we might get a very, very different year in 2023. And last but not least, we have to see the charts. This is how the long-term S&P 500, which is indicated by the SPX, that's the index ticker, over time, you can see that when you go to the lows of the 2008 and the lows of the COVID, and you connect the two lines, you might get to a point where if the market wants to touch the same trend line, we might go down around 19 to 20% on the S&P. That would be a huge decline from where we are today, 20%. It would bring us around 3,000 or 3,100 for the S&P 500. But, and there's a big but here, if you go back and put on the half of this trend line from peak to trough, you see that you still have 2018 and you still have 2011, which the S&P bounced on that trend line twice and 3 times this year on the last bottoming process that we had. Now, will we breach that bottom? Will we see a lower print than 34.91 and we will go down? Where to? I don't know. This is the red line that indicates the end of the year. This is the red line that indicates the end of 2023. We are now at a point where the market needs to decide where it wants to go. And one thing that we learned in 2022 is that the market has its own unique personality and it doesn't listen to anyone, not the analysts, not us, not anyone that is shouting at it. At the end of the day, the market does what the market wants to do. And by that, we have just ended 2022. Welcome to 2023. If you enjoyed what you saw on this video, it would be great if you can subscribe to the channel if you haven't up to now and smash that like button. I want to thank you for staying for this whole video of summarizing 2022, starting 2023. It's going to be an amazing year for sure. Whether it's going to be a green year or red year, I don't know, but I do know that the volatility, the Fed, the inflation, the unemployment, the dollar, the Russia, Ukraine, China, everything is going to be so dramatic that we're going to be in this channel covering everything, and videos are going to start being uploaded more frequently than they were in 2022. By that, I want to say thank you and happy new year. Till the next video, I'm Micha Stocks, and let's talk stocks with Micha Stocks. Till the next video, bye-bye.